Welcome to this full guide on Japanese candlestick patterns. In this video, we are going to walk you through the common bearish candlestick patterns and the bullish candlestick patterns. We will show you how to identify each of these candlestick patterns when you see them on the chart and how to trade with each of these candlestick patterns. And without further ado, let's start with the bearish candlestick patterns. When trading Forex as contract for difference, you know it's possible to profit by speculating that price will go high. And if price does go high, you profit from the difference between the opening and the closing price. On the same note, it's also possible to profit by speculating that price is going to go low. And if price does goes low, then you profit from the difference between the opening and the closing price. So in today's video, we are going to be talking about bearish candlestick patterns. These are candlestick patterns that when you spot on the chart, then you expect a market downtrend or a reversal from an uptrend to a downtrend. And when you spot this chart and you confirm that there's actually a downtrend, then you can actually enter a trade. And if price does go low, you profit from the difference between the opening and the closing price. Bearish candlestick patterns form when sellers take control of the market and push prices lower during a specific time frame. So when you notice that the markets have been in an uptrend for a while and you are suspecting that the uptrend is about to end and there will soon be a downtrend, you want to be on the lookout for bearish candlestick patterns. Before we start discussing each of the candlestick patterns we have for you in this video, let's refresh our memories a bit. Now remember that each candlestick you see on the chart shows 4 important price points. First, the opening price, that is where price began during the time frame. Second, the close price, that is where price ended during the time frame. For bearish candlesticks, the close price is usually lower than the open price. 3. The highest price, that is the highest point price reached during the time frame. And 4. The lowest price, that is the lowest point price reached during the time frame. By understanding bearish candlestick patterns and key price levels, traders can anticipate selling opportunities and position themselves ahead of a market downtrend. Now that we have this out of the way, let's start with our first candlestick pattern, the bearish engulfing candlestick pattern. The bearish engulfing pattern is a 2 candlestick reversal pattern that signals a potential change in the market direction from bullish to bearish. It forms when a small bullish candlestick is followed by a larger bearish candlestick that completely engulfs the body of the previous bullish candlestick. This pattern suggests that sellers have gained control of the market, indicating a potential reversal from upward trend to downward trend. Keep in mind that a bearish engulfing candlestick pattern is more significant when it appears after a significant uptrend. This indicates that the bullish momentum is fading away and there's a potential bearish reversal that's in play. A bearish engulfing pattern indicates that a bullish trend may be losing strength and a bearish reversal could be starting. It also indicates an increased selling pressure. The large bearish candle shows that sellers have overtaken the market and are now overpowering the bulls who were previously in control. Of course, by now you already know that a bearish engulfing pattern signals a change in trend. That's from an uptrend to a downtrend. However, you should wait for confirmation before taking any action. Now let's go ahead to discuss how to trade a bearish engulfing pattern. First, you want to wait for confirmation. Do not trade solely on the appearance of a bearish engulfing pattern. You want to wait for the next candlestick to confirm the bearish reversal. A strong bearish close after the pattern strengthens the signal. Secondly, you want to combine this pattern with support and resistance. A bearish engulfing pattern is more powerful when it forms near a key resistance level. You can also use trend lines, moving averages, or Fibonacci levels to confirm potential reversal zones. If you are yet to see the video on Fibonacci retracement, then you want to visit mytradingland.com and go to the University tab. I'll also leave a link in the description to that video. You also want to consider using indicators to confirm the signal you get from the bearish engulfing candlestick pattern. You can use indicators like MACD or relative strength index for further confirmation. For example, you can see on the chart that this bearish engulfing pattern forms near key resistance level. You can also see that the Fibonacci retracement confirms the signal from the pattern. After that, you see that there was a downtrend, meaning that if you had entered the market by selling at this point, you would have made profits. And now, at what point do you enter the market when you see a bearish engulfing pattern? You want to enter a trade after confirmation of the bearish reversal and then place a stop loss after the high of the second candlestick in the pattern to limit risks. The next candlestick on the list is the evening star candlestick. The evening star candlestick is a 3 candlestick pattern that signals the potential end of an uptrend and the start of a bearish trend. Now here's how you identify an evening star candlestick on the chart. The first candle is a large bullish candle which shows strong buying momentum. This candlestick indicates that an uptrend is still in play. Now the second candle, which we also call the star, is a small bodied candle, often a doji or a spinning top, which opens above the first candlestick close and closes either higher or lower, but its body should be small. The star candle represents indecision or a pause in the current trend. Now, if you do not know how to identify a doji or a spinning top on the chart, then you want to see the video on single candlestick patterns. I'll leave a link in the description below, but you can also visit mytradingland.com to watch that video. Now, the third candlestick is a large bearish candle, which closes well into the body of the first candlestick. This candlestick confirms that sellers have taken control and the trend may be reversing to the downside. The evening star pattern is most significant when it appears after an extended uptrend, indicating that buying pressure is fading and a bearish trend could be starting. Now, how do you trade an evening star candlestick when you see it on the chart? As usual, you should always wait for confirmation. Like most reversal pattern, the evening star should be confirmed by the next candlestick. A strong bearish close after the pattern strengthens the signal that a reversal is occurring. Secondly, you want to combine the evening star pattern with support and resistance. The evening star pattern is more significant when it forms near a resistance level or after an extended uptrend. You also can confirm this using trend lines, moving averages, Fibonacci retracement. And of course, to enhance accuracy, you should use indicators like relative strength index, MACD, or whatever indicator that suits your strategy. After confirming a bearish reversal, the next thing you want to do is to enter a trade and hoping that you make profit. To enter a trade, you want to place your stop loss above the high of the second candlestick in the pattern to ensure protection in case the market moves against your favor. The next candlestick on our list is the dark cloud cover candlestick. The dark cloud cover is a 2 candlestick bearish reversal pattern that appears at the top of an uptrend, signaling a potential trend reversal from bullish to bearish. To identify a dark cloud cover candlestick pattern, when you see it on the chart, here are some characteristics to keep in mind. So first, the first candlestick is a large bullish candlestick signaling strong buying pressure and an ongoing uptrend. It should close near its high, indicating that buyers are in control. The second candlestick is a large bearish candlestick that closes above the high of the first candlestick, but closes at least halfway into the body of the first candlestick. This particular candlestick represents a sharp shift in sentiment as sellers are taking control of the market and they are pushing price lower, and the reversal to the downside may be imminent. Now, how do you trade a dark cloud cover? First, you want to wait for confirmation, like every other candlestick we've discussed and every other one we are going to discuss. Wait for confirmation. Now, it's not as though it is impossible for you to just open a trade the moment you see a bearish reversal candlestick pattern or any other candlestick pattern, but by waiting for confirmation, you are being more careful, and it's actually a good risk management strategy to wait to see the next candlestick that forms to confirm that actually there's a bearish reversal before you enter the market. So you don't just enter the market and at the end it's a false signal and you make losses. So to minimize losses, wait for confirmation. A strong bearish close after a dark cloud cover pattern forms confirms the bearish sentiment. You could also look for follow-up candlesticks that continue the downward movement. Now, of course, you also want to confirm using support and resistance, Fibonacci retracement, and technical indicators. Once you've confirmed that there's a bearish reversal, then you can enter a trade. Enter a short position below the low of the second candlestick if you're a risk taker, or after the pattern is confirmed by the next candlestick if you are being more cautious. Then you can place a stop loss just above the high of the first candlestick to protect your position in case the trend reverses back upward. That's in case you have a false signal. The next candlestick on our list is the marubozu candlestick. A marubozu candlestick pattern is characterized by a long body and little or no wicks or shadow on either side. This pattern indicates strong buying or selling pressure depending on whether it's a bullish or bearish marubozu. The absence of wick shows that the price moved in one direction throughout the entire trading session without much opposition. It's a powerful indicator of market sentiment and trend direction. Now, you should keep in mind that there's a bullish marubozu candlestick and there's a bearish marubozu candlestick. And the bearish marubozu candlestick is what we are referring to in this video. When you spot a bearish marubozu at the start of a downtrend, it signifies further selling pressure. Now, here is how you trade a bearish marubozu candlestick pattern. Enter a short position at the close of the bearish marubozu or after a rally to resistance. You can place your stop loss above the high of the marubozu or above the nearest resistance level. Set your profit targets based on the prevailing trend and key support levels. Up next, we have the 3 black crows candlestick pattern. 3 consecutive long-bodied candles that close lower each day, forming a distinct pattern. The pattern indicates a strong reversal from an uptrend to a downtrend. It suggests that market sentiments have shifted from bullish to bearish and sellers have taken control. Here's how to identify the 3 black crows pattern when you see it on the chart. First, the pattern consists of 3 consecutive long bearish candles, that's red or black candles, each closing lower than the previous one. These candles should not have long upper shadows, signifying that sellers control the market price action throughout the session. Now, while the candles should close progressively lower, they don't necessarily have to open with large gaps down. A large gap may add additional strength to the pattern, but it is not a requirement for the 3 black crows pattern. Now, the 3 black crows pattern typically sits at the top of an uptrend, signifying a potential reversal to the downside. Each candle in the pattern shows increasing selling pressure as the bears push price lower, closing each candle at a progressive lower level. Here's how to trade with the 3 black crows candlestick pattern. Enter a short position after the 3rd candle in the 3 black crow pattern closes. This confirms that the reversal is in motion. However, traders who are more cautious may also wait for minor retracement or resistance level to strengthen their entry position. Place a stop loss above the high of the 3rd candle or above the resistance level to protect against potential reversal in the market. Set your target profit at key support levels where the price may find a floor. Additionally, use technical indicators like moving average or Fibonacci retracement levels to identify potential exit points. The next bearish candlestick pattern on our list is the bearish harami candlestick pattern. The bearish harami is a 2 candlestick pattern that signals a potential reversal from an uptrend to a downtrend. The word harami means pregnant in Japanese, describing how the 2nd candle fits entirely within the body of the first, resembling a small baby inside a larger mother candle. This pattern indicates indecision or weakened buying pressure, hinting that a reversal to the downside may occur. Here's how to identify a bearish harami candlestick pattern when you see it on the chart. First, it is made up of 2 candlesticks. The first candle is a large bullish, that's green or white candle that signifies strong buying pressure. The second candle is a small bearish, that is red or black candle, whose body is entirely contained within the body of the first candle. You should also note that there should be no overlap between the body of the 2 candles. The second candle's body should open and close within the range of the first candle's body. Typically, the bearish harami forms at the top of an uptrend, signaling that the buying momentum may be fading and there's an imminent downtrend. The bearish harami typically forms at the top of an uptrend, signifying that the buying momentum may be fading and there's an imminent reversal. Now here's how to trade using a bearish harami. Enter a short position after the second candle in the bearish harami closes. That's for those who are risk takers. But for people who are more cautious, traders may wait for price to break below the low of the second candle. Place your stop loss above the high of the first candle to protect against potential continuation of the uptrend. That's in case there's a false signal. And you can set your take profits at the nearby support levels or use technical tools like Fibonacci retracement levels or moving averages to identify exit points. Next, we have the Tweezer top candlestick pattern. The Tweezer top is a bearish reversal pattern formed by two consecutive candles at the peak of an uptrend. It signals that buying momentum is weakening and sellers may soon take control of the market. The two candlesticks that make up this pattern have nearly identical heights, which resembles the tweezers used in daily life, symbolizing resistance at a particular price level. This pattern is often a warning sign for traders to consider exiting long positions. So let's say you previously opened a long position and you've been making profit, but then you see a tweezer top pattern forming on the chart. See that as a warning to exit your long position, because this pattern signals that buying pressure is weakening and there's most likely going to be a reversal to the downside. Aside from being a warning to traders to start exiting long position, this pattern is also a signal to traders to start preparing for selling opportunities. Here's how to identify a tweezer top pattern when you see it on the chart. Like we already said, this pattern requires two candlesticks. The first candle is bullish, that is a green or white candlestick, and it represents buying pressure during an uptrend. The second candle is bearish, that is a red or black candlestick, and it signifies that sellers have entered the market and are pushing the price down. Secondly, you want to keep in mind that the defining feature of a tweezer top is that both candles have nearly identical or exact height, indicating a strong resistance level. Usually, this pattern appears at the top of an uptrend, often making a significant price level where buying pressure is exhausted. And the transition from a bullish to a bearish candlestick shows that there's a shift in sentiment and sellers have taken control of the market. The reason why we learn about these candlestick patterns is to trade with them. So how do you trade a tweezer top candlestick pattern? Enter a short position after the second candle of the tweezer top closes. That's if you're a risk taker. But if you are being more cautious, then you want to wait for price to break below the nearby support level before you enter a short position. Place a stop loss above the high of the tweezer top pattern to protect against false breakouts or a continuation of the uptrend. You can set your take profits at key support levels or use tools like Fibonacci retracement levels or moving averages to determine exit positions. The next candlestick pattern on our list is the shooting star candlestick pattern. The shooting star is a single candlestick pattern that appears after an uptrend and signals a potential reversal to the downside. Here's how you identify a shooting star candlestick pattern when you see it on the chart. First, it has a small body. The small body near the lower end of the candlestick shows that the opening and closing prices are close, despite an earlier attempt to push prices higher. It has a long upper shadow or wick. The upper wick must be twice the length of the real body, showing that buyers drove the price up significantly, but sellers regained control and pushed it back down before the close. It has little or no lower shadow. A minimal lower shadow or none at all indicates that markets closed near the session's low, reinforcing the bearish sentiment. And then lastly, the location on the chart. A shooting star candlestick typically forms at the top of an uptrend or near a resistance where it signals a potential bearish reversal. Now, how do you trade with a shooting star candlestick? Of course, like any other candlestick, you want to wait for a confirmation. Wait for the next candlestick to confirm reversal with a bearish close. Once you've confirmed a trend reversal, you want to enter a short trade below the shooting star's low and then place your stop loss above the high of the shooting star to protect against false signals. The next pattern on our list is the hanging man candlestick pattern. The hanging man is a single candlestick pattern that appears after an uptrend and signals a potential bearish reversal. Here's how to identify a hanging man pattern when you see it on the chart. First, it has a small real body. The small real body near the top of the candlestick shows that the opening and closing prices are close despite significant selling pressure during the session. It has a long lower shadow, and this long lower shadow must be twice the length of the real body, indicating strong selling pressure that pushed price lower before buyers rushed to push them back up. It also has little or no upper wick or shadow, and the absence of an upper wick or shadow emphasizes that the session was dominated by downward movement. And a hanging man pattern forms at the top of an uptrend or near a resistance level, signaling potential bearish reversal. To trade a hanging man pattern, you want to first of all wait for confirmation. Wait to see the next candlestick that forms after the hanging man candlestick closes. If the next candlestick that formed also has a bearish close, then you have a confirmation. You can also confirm the signal from a hanging man candlestick using support and resistance and Fibonacci retracement tool. Note that a hanging man pattern that forms near key resistance level is more significant. Once you've confirmed a bearish reversal, then you can enter a trade. Enter a short trade below the hanging man's low and place your stop loss above the high of the hanging man to manage risks. Throughout this video, I kept emphasizing the importance of confirming the signal you get from any of these patterns, and I kept saying you can use support and resistance, trend lines, moving averages, Fibonacci retracement tools. And if you do not know how to use these tools yet, then that's not a problem. On this channel, we have videos on how to use support and resistance, Fibonacci retracement tools, relative strength index, MACD, and other indicators. So you want to watch those videos to learn how to use these tools to confirm the signal you get from your bearish candlestick pattern. You also want to keep in mind that when you bring in your knowledge of how to use technical indicators, support and resistance, trend lines, Fibonacci retracement, when you bring them together with your knowledge of candlestick patterns, you see how they can all be used to confirm the signal you get from either of them. So if you get a signal from a support level, when you see a candlestick pattern that formed in that support level, it gives you context to see that, okay, this candlestick pattern has confirmed the support level, and the support level has also confirmed the candlestick pattern. As we can see in this chart, you see how this candlestick pattern is confirming the support level, and the support level is also confirming the candlestick pattern. If you watched the video on how to use Fibonacci retracement, you also see how I kept saying, watch for the next candlestick that forms after price reaches the significant fib levels. So you see how these candlestick patterns are also useful for confirming the signal you get from Fibonacci retracement tools. So all of these are intertwined, and when you understand them properly, you are able to build a solid trading strategy for yourself. Now let's move on to the bullish candlestick patterns. Bullish candlestick patterns are powerful tools for Forex trading, signaling potential upward price movements. These patterns form when buyers dominate the market, driving the price upward over a specific time frame. As you should already know, each candlestick tells a story showing key price levels. The open price, that's where price started during the time period. The close price, that's where price ended during the time period. The high price, that's the highest point price reached during the time period. And the low price, that's the lowest point price reached during the time period. By analyzing bullish candlestick patterns, traders can predict trend reversal or continuation, helping them make informed decisions in the market. Without further ado, let's start discussing the top bullish candlestick patterns, starting with the bullish engulfing candlestick pattern. The bullish engulfing pattern is a two candlestick bullish reversal pattern that forms during a downtrend. It indicates a potential shift in market sentiment, signaling that buyers have taken control after a period of selling pressure. The pattern gets its name because the second candle engulfs the body of the first candle, showing a dramatic shift in momentum from bearish to bullish. This is a key indicator of a potential upward trend. Now let's see the characteristics of a bullish engulfing pattern. These characteristics will help you identify the bullish engulfing pattern when you see it on the chart. First, this candlestick pattern is made up of two candlesticks. The first candlestick is bearish, that is red or black, reflecting continued selling pressure in the downtrend. The second candlestick is a bullish, that's a green or white candlestick that completely engulfs the body of the first candlestick, signaling strong buying momentum. Always note that the body of the second candlestick is larger than the body of the first candlestick, and the body of the second candlestick completely covers the first candlestick from open to close. Another thing that should help you identify a bullish engulfing pattern when you see it on the chart is that it is usually located at the bottom of a downtrend. And note that it signals potential reversal from the downside to the upside. Now, how do you trade a bullish engulfing pattern? Let's discuss that. First, to enter a long position after the second candle of the bullish engulfing pattern closes. For added confirmation, wait for price to break above the nearby resistance level. Place your stop loss below the low of the bullish engulfing pattern to manage risks in case the reversal fails. And then for your take profit, set take profit targets at key resistance level or use tools like Fibonacci retracement level or moving average to determine exit points. Always keep in mind that you can use tools like Fibonacci retracement and indicators like MACD and RSI to confirm the signal that you get from the bullish engulfing candlestick pattern, or to confirm the signal you get from any candlestick pattern actually. Always confirm the signal, and you can use these tools. Now the next candlestick patterns we are going to look at is the hammer and inverted hammer candlestick patterns. The hammer and inverted hammer are single candle bullish reversal pattern that signify potential trend reversal when they appear together after a downtrend. The hammer shows strong buyers' interest after a sell-off, indicating rejection of lower prices, and the inverted hammer complements this signal, highlighting buyers' pressure despite an initial push by sellers. When these two patterns appear consecutively or in proximity, they reinforce the likelihood of a bullish reversal. Now let's talk about how to identify a hammer and an inverted hammer on the chart. Now, these are the characteristics of a hammer and inverted hammer. The hammer has a small rear body, positioned near the top of the candle's range. It also has a lower long shadow that is at least twice the length of the body, signaling a rejection of lower prices. And then a minimal upper shadow that reflects limited price movements above the opening price. For the inverted hammer, it has a small real body, positioned near the bottom of the candle's range. It also has a long upper shadow that is at least twice the length of the body, indicating resistance of higher prices, but hinting a potential buyer strength. Lastly, the inverted hammer has minimal lower shadow that reflects limited price movements below the opening price. Like I said, when both candles appear after a downtrend, it signals potential trend reversal to the upside. Now, how do you trade using the hammer and the inverted hammer? Enter a long position after the patterns form and a confirmation candle, that's a bullish candle, closes above their highs. Set your stop loss below the low of the hammer for risk management, and then use resistance levels, moving average, or Fibonacci retracement as key profit targets. Remember to always confirm the signal you get from your candlestick patterns using RSI, MACD, Fibonacci retracement, and even support and resistance. Now, the next candlestick on our list is the Morning Star candlestick pattern. Morning Star is a 3-candle bullish reversal pattern that signals potential of a trend reversal from a downtrend to an uptrend. This pattern reflects a shift in market sentiment where bearish momentum weakens and bullish strength take over. Now, how do you identify Morning Star candlestick on the chart? Here's how. Remember that this candlestick pattern is made up of 3 candlesticks. The first candlestick is a long bearish candle indicating strong selling pressure. The second candlestick is a small bodied candlestick that it can be bullish, bearish or neutral that represents indecision or a pause in the trend. And the third candlestick is a long bullish candlestick that closes well above the midpoint of the first candle, confirming the reversal. For context, the morning star candlestick always forms at the bottom of a downtrend, signaling potential reversal to an uptrend. And it shows a shift in market sentiment as there's a transition from seller's dominance to buyer's strength. Now, how do you trade using the morning star candlestick pattern? Here is how. Enter a long position when the third candle closes above the midpoint of the first candle or after the next bullish confirmation candle if you are more conservative. Set your stop loss below the low of the second candle to manage risks. And for take profit, use key resistance levels, Fibonacci retracement tools, or the recent swing high as take profit targets. Remember to always confirm the signal you get from your candlestick patterns using Fibonacci retracement, MACD, RSI, and support and resistance. The next candlestick pattern on our list is the 3 white soldiers candlestick pattern. The 3 white soldiers is a bullish candlestick pattern that consists of 3 consecutive long bullish, that's white or green candles. It typically appears after a downtrend and indicates a strong shift in market sentiment, where buyers overpower sellers, signaling the beginning of a potential uptrend. Here's how to identify the 3 white soldiers on the chart. First, remember that this candlestick pattern is made up of 3 consecutive long bullish candles. All 3 candles are long and bullish, showing strong buyer's pressure, and each candle closes higher than the previous one. This pattern forms at the bottom of a downtrend, signaling reversal to the upside. Now, you should also keep in mind that the candles in the pattern usually have little or no gaps between them, indicating consistent buying momentum. Lastly, each successful candle opens near or within the previous candle's body, demonstrating a continuation of bullish strength. Here's how you trade using the 3 white soldiers pattern. Enter a long position after the close of the third candle, especially if the candle closes near its high, confirming the strength of the upward movement. Place a stop loss below the third candle or just below the low of the second candle to manage risks. Set your take profit at key resistance level or previous swing high where the price may face some resistance. Always remember that you should confirm the signal you get from your candlestick patterns. And you can do this using indicators, Fibonacci retracement, and support and resistance. Next, we have the Tweezer bottom candlestick pattern. The Tweezer bottom is a bullish reversal pattern that consists of 2 candles with matching lows forming at the end of a downtrend. It signifies a potential shift in market sentiment from bullish to bearish. This pattern indicates that sellers have exhausted their downward momentum and buyers are starting to take control, signaling potential beginning of an uptrend. Here's how you identify the Tweezer bottom candlestick pattern when you see it on the chart. First, you should keep in mind that this pattern is made up of 2 candlesticks with matching lows. The first and second candles have nearly identical lows, confirming that price have tested this level multiple times and have found support. Then you should keep in mind that the first candlestick is typically bearish, that is red or black, and continues the downtrend but reaches a significant low. And the second candle is usually a bullish, that's a green or white candle, that opens below the previous low but closes near or above the first candle's open, showing signs of buyer strength. And of course, for context, the Tweezer bottom candlestick patterns appear at the bottom of a downtrend, signaling buyer strength and a movement from downtrend to uptrend. Now, here's how to trade using the Tweezer bottom candlestick pattern. Enter a long position after the second candle closes, especially if the second candle is a strong bullish candle that closes near its high. Place your stop loss just below the low of the second candle or slightly below the key support level to protect against any potential downside. Set your take profit at nearby resistance levels or at the most recent swing high where price could potentially face resistance. And of course, Remember to confirm the signal you get from the tweezer bottom candlestick pattern. Always confirm the signal you get. The next candlestick pattern on our list is the bullish harami candlestick pattern. The bullish harami is a 2-candle reversal pattern that signals a potential shift from downtrend to uptrend. The pattern consists of a long bearish, that's a red candle, followed by a smaller bullish, that's a green candle, that is completely contained within the body of the first candle. This pattern suggests that seller strength is weakening and buyers may be starting to take control, potentially leading to a reversal. Now here's how you identify a bullish harami candlestick pattern when you see it on the chart. First, keep in mind that this pattern is made up of 2 candlesticks. The first candle is a large bearish candle that indicates strong selling pressure. The second candle is a smaller bullish candle where the open is within the body of the first candle and the close is higher than the open. This shows that buyers are starting to gain control. And for context, the bullish harami candlestick pattern appears at the bottom of a downtrend and signals a potential reversal from downtrend to uptrend. Now here's how you trade using the bullish harami candlestick pattern. Enter a long position after the second candle closes, especially if the second candle is a strong bullish candle. The confirmation from the small bullish candle suggests that buying momentum is starting to increase. Place a stop loss below the low of the second candle or below the most recent support level, protecting your position in case the market does not follow through with the reversal. And you can set your take profit at nearby resistance level or recent swing high where price could encounter resistance. And of course, remember to confirm the signal you get from your candlestick patterns. The next candlestick on our list is the Doji candlestick pattern. The Doji candlestick pattern is one of the most widely recognized candlestick patterns in technical analysis. The Doji signifies indecision in the market where neither buyers or sellers are in control. So a Doji candlestick pattern can signal potential trend reversal or continuation depending on the context and the surrounding price action. Now here's how you identify a Doji candlestick on the chart. The Doji candlestick has a small body where the opening and closing prices are nearly the same. This indicates that the market closed very close to where it opened, showing indecision. The Doji typically has a long upper and lower shadow or wicks that indicate significant price movement during the session, but the price eventually closed near its open, reflecting a struggle between buyers and sellers. And of course, like I said earlier, the Doji candlestick pattern signifies indecision in the market. Neither buyers or sellers are in control. Now, you should also know that there are different types of Doji. We have the long-legged Doji, the gravestone Doji, and the dragonfly Doji. Now, you want to take time to observe each of these Doji patterns to see how they differ from each other. Now, here's how you trade using the Doji candlestick pattern. After spotting a Doji, wait for confirmation from the next candle. If the Doji is followed by a strong bullish candle in a downtrend, enter a long position. But if it's followed by a strong bearish candle, then you may want to consider entering a short position. Now to place your stop loss just below the high or low of the Doji candle, depending on whether you are going long or short. This protects your trade. And for your take profit, if you're expecting a reversal, you want to set your take profit at recent support or resistance level, depending on whether you're going long or short. And if you're expecting a trend continuation, then use the trend's direction to set your target profit based on the previous price movement. Always remember to confirm the pattern you get from any candlestick pattern, especially a Doji. So you want to confirm the pattern by waiting to see the next candlestick that forms. And also, you can confirm the pattern by using support and resistance, RSI, MACD, Fibonacci retracement levels too. Now to conclude, bullish candlestick patterns are very important tools in technical analysis. But like I've been saying throughout this video, ensure to confirm the signal you get from any bullish candlestick pattern. And if you followed our video on Fibonacci retracement, how to use different indicators, and all of our candlestick patterns, you see how useful all of these tools are when used in combination. Understanding how to read bullish candlestick patterns is important for building a strong trading strategy. Always remember that successful trading is about stacking the possibilities in your favor. Practice spotting these patterns and combining them with reliable confirmation strategies to help you make more informed decisions. This video is a part of our product called My Trading Land, and the aim of this product is to help you learn the basics of Forex trading and interact with other Forex traders to help you just make better informed decisions. To join our trading community, just visit mytradingland.com. It is absolutely free of charge. You will not have to pay a dime. And you can always go to the university tab to learn more about the basics of Forex trading and to watch more videos like this or to read text-based trading training content. I hope you found this video helpful. If you did, don't forget to give it a thumbs up and of course, subscribe to this channel. You should also consider turning on bell notification so you are notified when new trading videos like this one are uploaded. Thank you.